Okay, there. That way we can send that to you tomorrow, and if you want to
Perfect.
watch it, you can do that.
Also,
Okay, and then
also,
I tell you, when you
quick-
got a lot of stuff going on, you really got to be disciplined
yeah,
in terms of what's going on. So I'm gonna put my 40 call over here,
yeah,
and I'll put my 50 put over here, and then I'm gonna put my numbers in here. And it says I paid 6 for the call.
right.
It says I paid 8 for the put. Boom. And then it says if both options are sold for intrinsic value. So what I'm going to do now is 44. So I'm going to get a different color here. And I would put 44 over my strike of my call.
Mm-hmm.
And I'm going to put 44 either above or below, depending it, for example, if this was 52, I'd put it above.
Okay.
Right. So I like to put the market price above that. Now they're saying I'm going to offset. Right. So offset, that's what both options are sold for in. Ooh, Dean's got a little bit of a problem here. I almost got messed up here.
I was going to say we didn't add up the.
You got to be careful. Now that's the other reason to have process, by the way, is because if you have process, then you catch yourself. And here's how I caught myself here. I caught myself because it said both options are sold.
Right.
Right. And if they say both options are sold, that means originally. So I caught myself there. So let me get my thing fixed here. I don't necessarily need to fix it, but I'm going to fix it just because we want to have an organized kind of version of this thing going on. Okay, so now they say I close it out at intrinsic value. So now what I'm going to do is I'm going to take, put my 8 back in there, put my 50 put. And they say I close it out at intrinsic value. So what that means is I'm going to do the offsets, right? So I did opening purchases. Mm-hmm. And so now I'm going to do my closing sales. Okay, so what is the intrinsic value? What is the intrinsic value of a 40 call with the stock at 44?
4 points of intrinsic value.
Right? Call up. So they're saying we closed it out at intrinsic value. And what is the intrinsic value of a 50 put with the stock at 44?
That's 6 points of intrinsic value.
And then what I'm going to do is I'm just going to simply net my T. That's all about the T, all about the T. And so we paid here for this combination, the straddle with different strike prices. We paid 14 and we sold it for 10. So I think we're a loser. Right? We're a loser because we got more money out than in. Now, I always do it on a per share basis. And that way, when I'm all done, what I'm saying is that I personally, Jimmy, this is again a buffet. If you don't like something, don't put it on your tray. But I think this is a mess to put 600 there and 800, because then you got all these zeros. I just like to, when I'm all done, say, okay, so 4 points on, we were talking about one contract times 100. And so when I'm all done, then I multiply to get that $400.
Yeah.
So that way I can do things on a per share basis. Now, the reason we were losers, by the way, the other way we could have done this is we could have combined. Let me just go show you that. We could have taken 40 plus 14 and got our upside break even of 54. Remember, the combinations and the straddles are the only ones where we have 2 strike prices or 2 break evens, excuse me. And I could have taken 50 minus 14 and got my break even of 36 as my downside break even. And then I could have said, okay, well, 44 is unfortunately inside the break evens. And I am long, I need it outside, silo, long outside, short inside. So I could have also got my break evens being here, the 54 and 36, and said 44 is a losing proposition. Right, because it's in there.
Right.
So a couple ways to proceed. If you get good at contract specifications and you can track money, you get 100 options. What I mean by that is if you, at some point, it comes with practice, drilling, and rehearsing, but if you can look at that and say that is a choice to buy the stock, And you can look at this and say, this is a choice to sell the stock. And you can track money, then you get 100 on options. Right. So the point you're saying, okay, I got a choice to buy at 40. And at 44, that's worth 4 points. And I got a choice to sell at 50. And at 44, that's worth 6 points. You know, at that point, you're going to get 100 options. So the minute you can track the options and you know the contract specifications, you're going to be getting 100 options. So that comes from the T, and you being able to track money. Any question on this one? Another tough one, by the way, but you said you were picking out the tough ones. So
yeah. So can you hear me better now?
A little better. Yeah, a little better.
Okay. Better. So on this one, if I, because
by the way, much better. I know what you did.
I figured it out. The microphone volume was all the way down.
Okay.
I could hear you. I could hear you so clear, but you wouldn't hear me because the microphone.
This is a professional mic, so I'd be.
Yeah, I was like,
I'm gonna say, what? I'm turning back in my mic. You want my money back?
I was like, yeah, it's definitely not Dean. You got the biggest mic possible. It's not gonna be him. If I do it the way that you did it the second time, because that's the way I did it, by calculating both break-evens, right? So how can I decipher that it's B 400?
Well,
can you do the T?
You would have been looking at yeah, I think it would have been tough because it's a combination. If it was if it was regular straddle, it would have been easier. It would have been the same numbers away. Here, yeah, it looks like
these gave me trouble.
Yeah, I don't know if you can. I'm thinking about it because if we put the 44 in there, it's not 4 points from either one. So you could have said here, I think you could have easily missed this with either 1,000, because you would have said 44 is 10 points from the break even. Right. That would be one way to miss it. Or you would have said 44 is 8 points. I don't see that as a choice. Yeah, I don't think you could. I think you had to do the T on the combination only because you got these different strike prices here.
Yeah, combinations are pretty tough when it's like this.
Combination, you got to proceed with you know. Now outside it would have worked. What I mean by that, you know, this most of the time this wouldn't have been this complicated. What I mean by that is if this said if Chuck gave you a number outside the break evens, it would work. So, for example, if I told you the stock was 58 and you told me 4 point profit, you'd be right.
Okay.
So yeah, it's the reason it's not working is he's asking you the loss and a combo in between. So
right,
he had to go out of his way to make it this difficult. But I mean, that's Chuck, right? Let's see what his rationale is. I always like to read the rationale afterwards just to see.
I love that too.
The closing was 4. The difference of that is a $200 loss. So the opening purchase of the put. Oh, he's doing each leg separately, which I think is confusing.
That's the way I did it.
I did the legs, but I did them, at the same point, right?
Right.
So I think you're better with the T than thinking of as separate legs. But what he's saying is we bought the 40 call leg at 6 and we sold it for 4, and we bought the put at 8 and we sold it for 6. So 2 and 2 is the 400. So a lot of different ways. I think that's the challenge too. There's lots of different voices. So one of the challenges as a test taker is just how many voices you're listening to. So
Yeah, that's for sure. There's too many.
Right,
so Dean, I had a shot at the 7 in August.
I hate that. That's not knowledge deficit. That's unfortunate. It's changing. It's something. It's not that you didn't know it. I joke, but I'm not joking. I mean, I go back long enough that there used to not be a 30-day wait period. And Jimmy, I would literally tell my students, I call it the Dean rule because I think it may be in me that caused them to change that. And I literally tell you, Jimmy, you got a 70, you just pay your check right there on the spot. Say,
I got a 71.
Yeah, there, 71. I just say, stay down there, Jimmy. As long as you get it close to 70, it means there's a draw you can pass. I just say, hey, keep queuing it up, my friend. So now they make.
Oh man,
this is really, really important. So whenever you get this 100 shares,
right,
you got to really kind of stop and say, okay, this is not an option position. This is a stock position. Mm-hmm. And stock dominates. Stock dominates. So this is a covered call. This is a covered call, also known as a buy right. Also known as a buy right. So again, what we're going to do here is we're going to make our T to track the money in and out of the account.
Right.
And I call this the initial setup. So almost always you're going to have an initial setup. Sometimes when I'm helping people, I say, hey, where's your T? They're just staring at the thing. You got to do something. So if you can't decide what to do, a good place to start is say, okay, let's get a T fired up and see what's going on here. So we paid out. That's going to be money out for the stock, right? 100 shares at 23.50. Now, again, I personally think it's a mess to put 2,350. So I just like to believe in doing things on a per share basis.
Yep.
So I'm going to put that there. That's money out.
That's
and then
is that
too? Is that going to be money out or money in on that call?
That's money in.
Right on. You nailed it. And then, again, I like to, what I like to do is not testable again. But what I like to do is sometimes underneath the leg, what I like to do is just write what I'm looking at. And what I'm looking at here is
obligation to sell.
To
that helps so much. I do that every single time.
Good. I had a guy who's a very smart guy, and trust me, I mean, he didn't need to do that, but I was so impressed that he stuck to his process.
Yeah,
so that's an obligation to sell that stock at the strike price. Okay, so a couple things to do here. One thing we can do, and again, I like to do perhaps a lot of work before we even look at the question. I could say, okay, well, my break even is the stock cost. This is the one time and the one time only that to get the break even, we're actually subtracting in a call because this is not a call position. So we paid 23.5 for the stock, and we brought in 2 for the option. And so our break even, again, my arithmetic sucks. So anytime they offer me calculator, I'm taking
I'm with you on that. I always
minus 2 equals 21.5 as our break even. Now, if I didn't want to memorize break evens, I don't have to. What I mean by that is I could just, on the answer set, they're going to offer me 4 choices as potential break evens. And the good thing about math is that one of the choices being offered to you is correct. And so what I could do is I just could take all the numbers they offer to me and plug them into my T until I get one that would make the columns balance, because that's what break even is, same dollars out as dollars in. And to be honest with you, that's what Dean does. What Dean does isn't testable, but I told you my arithmetic sucks. And so what I do is I just get my T fired up and I just go over and shop the answer set.
That's right.
So I get one that makes that balance. So I would just then go, 21.5. So that's how I would proceed. Okay, so let's see. Our max gain is when the stock gets called away from us. We do not participate past the strike price.
Right.
That is the disadvantage of a covered call. So we're going to have to give up that stock at 25. So another way you could think of that, so let's just put that here. You could think of that as the most we're going to make is from the break even to the strike price.
Right.
What we mean by that is the most we can make is the 21.5 to the 25. We do not participate past the strike. By the way, that's 1.5 plus 2. Again, I could net the columns here, and that would be my max gain. So there's a lot of work where we actually get question answers. So let's see what they want to know.
Yeah.
And let's see what they want to know. Let's clean this up. So we're going to need our setup regardless of what they tell us. So we'll leave our setup in place, which is our setup.
What got me on this one, Dean, is the fact that they used unrealized loss, unrealized gain.
Yeah, what they're trying to say is that the option didn't get exercised.
Right.
So that's what that word means. Unrealized means it happened. So the stock is trading at 20. So what I would have done is your point. They're just saying that we're not going to actually close it out at 20. But if we did, right, that's what it looked like if we did that. Right. They're not saying we're going to do that. They're just saying the stock's at 20. So we look at that. I say, okay, well, we're down 3.5 points on the option or in the stock, Jimmy. We're down 3.5. I go, well, we haven't realized that 3.5 loss yet. But right now, you paid 23.5, my friend, for stock that's only worth 20. And I say, so you're down 3.5 on that. But good news, you got 2 for the call. So you were only down 1.5 points. You're down 1.5 points, right? If we net these 2 columns, We say, or we could just compare it to the break even, by the way. We could just compare break even to 20. That's another way to go. But we could say, okay, well, if we just sold the stock today, we're not going to, because remember it says unrealized. But if we realized it, that's what it looks like.
22,
And that's a tough one. You got, listen, all the ones you got, these are not aim and shoot point and clicks. You know, these aren't layups. You know, these are 3-pointers, right? So, unfortunately, the test isn't weighted, so you only get 1 point regardless of how difficult it is. Right?
Yeah.
So make sure you get these ones. Any question on that one? Another tough one. But I do like this phraseology. Be careful. Realized means you actually closed it out.
Right. Unrealized
means you're just, looking at it.
Right.
I said, Jimmy, what's your portfolio look like this year? You say realized or unrealized? I say, well, both. That means the stuff you've closed out as well as stuff you're still sitting on.
Yeah.
Right. Our friend Elon has an unrealized gain of $300 billion in Tesla. Unrealized meaning he's still sitting on $300 billion worth of Tesla.
Yeah.
He's got realized gains over the last month of $10 billion, right? That means he's actually sold the Tesla.
Right.
Now has that gain.
That's right.
Problems.
So so the majority of these questions, I'd say pretty much about 85, 90% of these questions are, and you would understand, section 2 of the Kaplan material, which is the biggest section of
yeah. Well, section 2 on the test is section 3, which is 91 questions.
Right. So I've been really focusing.
Where it's at.
Yeah, I've been really focusing on that.
And hey, listen, you sent this to me, and I'm gonna probably use this document to come up with Dean's versions of Chuck's questions.
Yeah, and that's the reason.
The Dean practice exam from hell.
Yeah, there you go. You're just gonna create a storm.
Stuff you could expect to see, right?
Honestly, I wanted to share this with you so that you can possibly help others. I'm on the Reddit.
If I have your permission, I'll definitely do it.
Absolutely. I follow your Reddit page. I follow.
Did you see Mike? I don't know if you saw Mike's tutoring session. He gave me permission to share it, and boy, so it's helped so many people.
That's exactly what I did. I saw Mike's. I saw the whole thing.
Yeah.
And I was like, I need to do something like that with Dean.
Yeah, I'm getting better at recording because same thing with you. I get started and I forget to hit the record button. So in his case, I do a debit spread. So
no worries.
Oh well. All right. So to create a credit calendar spread, an investor would. So that means we need to bring more money in than out.
These are challenging. It's something.
Yeah. And so what Chuck is getting at in this question, which I kind of like here, is this idea about 3 things that we'll make a note of. What he's getting at in this question is, do you know that longer term option contracts always have greater premiums?
Yeah.
So that's what this question is about. The other thing that we need to know is that lower strike call contracts
have a higher premium.
Always have greater premiums. And the last thing we got to know is that higher strike put contracts. Oh, I don't know what I did there. Don't do that, baby. Let's see. No thanks. Come on.
Also, Dean, your YouTube channel is just the shit, man. It's everything. It's everything, man.
I work hard on that. My mom gives me.
I know.
About. She goes, "Why are you giving all that stuff to people for free?"
I'm like, damn, Dean's mom gotta be quiet. She can't just tell these things.
Like to say, is that one of those mooches who aren't paying, or is that somebody who's paying? I said, oh no, he's paying. He got 2 hours of tutoring. Goes, oh, okay. So, I didn't know what to think. I started the channel because I didn't want to have a connection with test takers dependent on Kaplan and your sponsoring firm. And so I'm still new at like social media. I'm not very good at that kind of stuff, but I've been pretty pleased with, I didn't know what to expect, but we're close to 200,000 views and 3,000 subscribers. So as you know, on Reddit, I got lots of haters. I'm not used to
What?
having haters because I never hang out with people that don't like me.
I've
On
seen
social
it.
media, you got people. I'm like, man, I'm not used to
That,
this.
that only means you're doing something right, Dean.
I
That's for
think. I
sure.
mean, I've got a thick skin, so I don't. It doesn't bother me all that much. But
Yeah,
it's like, geez, why don't you guys get a life?
yeah, you got too much time on your hands to be doing that.
Okay, so now back to this question. So, if we're going to end up
Right.
doing a credit spread, we're going to need more money in than out, and so that means what we're going to do is we're going to buy the near because that's going to be cheaper, and we're going to sell the long, right? And so we're going to do 1 and 4. Now, if this was a debit, we would sell the near would be 3 and 2 would be the debit calendar spread, right? So you see how we did
So
that?
where
We
I'm-
did a credit calendar spread.
Yeah.
That means we need to have more money in than out. And so the way we're going to get more money is selling the longer term contract. And the longer
I don't know
term-
why. Right now, going through my head is I'm thinking, am I doing calls or puts? I know on a call.
Oh, it doesn't matter. It doesn't matter.
It doesn't matter?
They didn't tell you that part, but
Yeah.
it would matter if we create a credit put calendar put spread or credit calendar call spread.
Okay.
We would still do this way. The strikes wouldn't be meaningful to it. The strikes could be the same or different. If the strikes were different, it would be called a horizontal or diagonal spread, but it wouldn't
Right.
matter in terms of what we just talking about here. Just I'll give you an example. So if we buy, here we are in what is this? This is December. So we
Yeah.
sell the Apple December 160 calls. And we buy, excuse me, we're trying to create
Calendar spread.
so we buy Apple December 160 calls and we sell the Apple, I don't know, June 160 calls. Boom. And then here where we're not trying to make money here. What we're trying to do is collect, we're hoping the 160 June's expire and I get to keep the money. So it's
Okay.
not really a play on price. It's a play on time.
Okay.
That's why it's called counter spread, but tough.
So
But what it's getting at here is that how do you create the credit? And that's the 1 and the 4, right? And by the way, that wouldn't be any different if I changed this. I could do that. It wouldn't matter if I changed this to puts. It would still be a credit spread, right? If I put
So
this isn't
okay,
about
yeah.
what call or put. It's about the
the
time,
month.
the month, indeed. Be the same thing. Tough one again. Tough one.
Yeah, I thought this was
And anytime credit, though, remember that's true. Anytime it's a credit, you definitely want the contracts to expire so you can keep the money.
Yeah,
So-
credit expired now.
And then here's your answer set. And we said it's going to be number 1,
And four.
number 4. There we go. So we got it right. Good news. Your tutor got it right.
Yeah.
Credit counter spread occurs when the premium receives amount of bidding. Investor creates by selling the distant, buying the near. And therefore, yeah, that's kind of what he's getting at.
I guess what's important there also is that the distant expiration has more time. Yeah, the distant expiration has more
exactly,
time.
exactly. Remember,
And
that's
therefore high
those
premium.
3 things. T-bill auction. So an investor watches the latest T-bill auction fall from 4.7 to 4.82. Okay, so it's kind of the grammar here is kind of atrocious, but what you're seeing is that the interest rate is going up, right? And so the interest rates are going up, right? Because it falls from 4.71.
No, actually the opposite. So it falls from 4.82 to 4.71.
Oh,
So,
I thought it was falling the other direction. Okay.
yeah, this is yeah, it's like you said, RTFQ.
Right on. So yeah, so
it went down, so it pushes the price up.
The yield went the other way, right?
Right. So it
what
pushes
this
the
is
price up.
testing you on is, do you understand that if interest rates go up, the price goes down. And if interest rates go
Right.
down, the price goes up. So kind of
Right.
complicated way to ask that, but that's what it is. You should have got tossed out A,
Yeah.
because there's nothing in here to say that it's something about Fed funds, right?
No, no.
So, another tough one, another fall to from. Yeah, well, you're right. RTF kept fall to.
That's you're
man.
easy. It's easy to point. Yeah.
Yeah, grammar.
I'm telling you, I hand selected all these questions. Dean,
No, I
all
can
of them.
tell. I can tell. I can tell.
Yeah.
All right. An investment company holds which of the following does not meet the definition of the diversification. Now, so remember, the diversification is I have to have 75% of my portfolio invested in such a fashion that no more than 5% is any one position. And I cannot have or be a principal stockholder.
Right.
So,
And that would be 10%, right?
yeah, that's right. That's exactly right. So we look at A. It has 4% of its assets invested in stock. Now, what I like to do on these is I like just to make up a number so I can kind of look at it. So I like to say, okay, I'm managing $100 million fund. I just made that up.
Okay.
And then it makes it easier when I'm reading the question. So now I can say 4%. So I got $4 million of my 100 million in one stock. No problem.
Okay.
No problem. B, I own 8% of the voting stock. You nailed it. It's not 8, it's 10. No problem.
It's 10. Yeah.
33%. That's more than 25, right?
That's more.
That's the problem, 33. And then D says 80%. That's kind of a trick because, again, if we don't read the whole sentence, we might say it's D, but then it tells us that that's 80 million I got in 50 different healthcare companies.
So the fact that it's 50 different companies
and that's why I made up the 100 million, right? Because now it's 80% is 80 million. 80 million of my portfolio is in 50 different companies.
Right.
Yeah, that's fine.
So the reason why I chose this question is that, it's easy to remember that, the set limit is 75, 5, 10.
Yeah.
But then when you go through the answer set, you can, in a way, be confused, based on the numbers that they give you.
Again. Easy, indeed.
Yeah.
Indeed.
Mhm.
So, yeah, I mean, a lot of times the aim and shoot point and click question, as you just brought up, is not going to be an aim and shoot point and click question, right? So you're hoping you're going to get some easy thing about 75, 5, and 10, wham, bam, I'm out. And then you get to like this, you got to slow down and go, okay, well, this would got you in the weeds a little bit for sure.
Right. Okay.
Ooh, oh my goodness. I'm not going to read that because we're going to do it together, but I would tell you that whenever you get an rationale that large, I sometimes say, that's a poor question. If we have to take that long to explain it to you, probably not bueno. But let's go through this. Let's go through this and see what's going on. So a customer creates a long straddle by buying 5 50 calls and 5 November 50 puts, paying a total premium of $3,750. Wow. So
this one was tough.
It's tough. And so I have to make a decision here. And it looks like I'm not going to be able to do this because of the way it's set up. I don't think I'm going to be able to do my per share thing. I'm going to have to do this in one big fell swoop.
Dean, on my draw, and I remember on my draw, I got a lot of straddles like this.
Did you? Okay, so this one's tough. So the first thing I'm going to do is I want to put my dollars out here. I paid a total of $3,750. I want to put that there. And then what I want to do is just remind myself that I'm talking about a 50 call and I'm talking about a 50 put.
You're straddling the 50.
That's exactly what's going on. You're exactly correct. That's exactly what's happening. Okay, so it says the stock goes to 56.50. So I told you what I like to do is I like to put that either above or below my strike. If it's 56, I put it above. If it's the call 49, I put it below. So I'm gonna put
where I remember going through this question exactly. And the first thing that came to mind was that how do I decipher both breakpoints when I get the total premium?
Well, yeah. Like so here, I don't think I would have tried to do the breakpoint because you'd have to divide you don't know what the premiums are to either side where you know the total is premium.
Yeah.
You could do that. I just think
So
that's
in my head,
with math, there's always a lot of ways to go. So
yeah,
I could have taken the 3750. I'm
divide
lazy.
by 2.
I'm always looking for the easiest way to proceed.
I'm with you.
So the reason, Jimmy, I didn't divide that is because I just thought once I start dividing,
Oh,
I'm gonna have to
man.
start dividing everything. And I just think this is gonna be an exception where I think I'm just gonna put it in here. And then what I'm gonna try and do, and that's what we're doing right now, is I'm gonna try and figure out what's going over here. Right. And I'm just gonna net it. And that way I don't have to do all the division and multiplication and all that kind of stuff. So that's what I'm gonna do. So now it says expiration of the customer. So now we know that if it's a 56.5, the put is going to expire.
It expires.
So I'm going to put that in my box. I mean, we don't know what the premium per was, but we know that the put expires. And
Yeah, so I knew that.
Have intrinsic value. So what I'm going to do now is I'm going to take the calls and say, okay, so the calls have 6.5 points of intrinsic value. There's 5 of them. There's 5 contracts, and each of these contracts governs 100 shares. And so now I'm going to be able to figure out what's I'm going to put in that dollar inbox. I'm going to take 6.5 times 5 times 100. And when I do that, I get 3,250. And so now that's what I'm going to close this out because they say ABC's expiration the customer has. So I could either do it that way, right? Now, another way I could have done it, so as I said, there's lots of ways to go with math. That's how I would have done it personally.
Yeah,
but another way you could have done it is you could have said, okay, well, the put is going to expire, but I'm going to end up exercising my call contracts,
so you have a
right?
choice
So
to
if I
buy.
exercise 5 of my calls, so I got 5 calls, and I can buy the stock at 50.
Right.
And each of those are 100 shares. I'm going to exercise. That's going to be $25,000. So that would be the other way I could proceed. Is I could say that I'm going to exercise my calls, and then I'm going to sell the stock at 56.50, and 56.50 times 5 times 100 is 28,250. And that would be the other way I could do this.
Right.
So I think that's a lot of work. I think what I would have done is just net the 2, right?
Net the 2.
What I mean by that is I would have just put this, I wouldn't have exercised. I would have just put the intrinsic value in there. That's what I would have done. Just because that's easier than exercising the contracts.
Yeah, I got a bunch of these. On
Yeah,
my
let's see
exam.
what Chuck tells us. We know that it's got a huge ass rationale. So
He's got a whole story for
what he
us.
tells us. When an investor goes long a straddle, the expectation is the stock's price will be volatile.
Right.
That's true. We know that. The direction up or down is uncertain. Yep, that's true. In this question, the stock price increased, putting the calls in the money. Yes. Remember, a 50 call with the stock at 56.5 is worth 6.5 points. At expiration, the call positions would be closed by selling them for intrinsic value. So looks like Chuck did what Dean did.
Yep, you went your way.
6.5, and we times it, and we got 650. There's 5, 3,250. Yeah, so he went about it the same way I did. Compare the 3,250, 3,750. Result is a loss of 500. The puts expired with us. Yeah, okay, so that's pretty much the same rationale that I provided, or we did. So again, you said you picked all the tough ones, and so far that is true. All right, let's see. A corporation has outstanding convertible interest could force conversion by. Yeah, this is where we tell you, listen, you're either going to have to turn in the bonds or convert the stock. So a tender, I call you as your broker. I say, Jimmy, the corporation has made a tender.
Right.
Tender just means an offer. So on your convertible bonds, they're offering to buy them at the call price. And do you want to tender them or do you want to exercise? Now, what we're going to do is see what the stock is worth. And if the stock is worth more than the call price, you're going to say, Dean, I think I'll convert.
Right.
Well, they force conversion, right? Now, if the stock price is worth less So then it looks like if I convert into stock, I'm going to end up with less money. Let's let them call the bonds from us. So A, C, and D are kind of nonsensical. B is the key word that makes B the right answer is tender. That's the key word, tender.
Right.
When a company's tendering, that means they're making an offer to you. Let's see what Chuck says on this one. Most convertible bonds are callable, usually at a price slightly above par. When the price of the underlying stocks converted value of the bond is worth more than par, there you go. So exercise know what you're going to do, right, Jimmy? They know that if the stock is worth more than the bonds, you're not going to make them pay you back. Because remember, you lent them $1,000 per bond. And so what the issuer is saying is, Jimmy, do you want your $1,000 back or you want X number of shares of stock? And we know that if X number of shares of the stock is worth more than the par, because they are call price, you're going to take that. All right, let's see. Now he gives us an example. It is only common sense that the debenture holders will exercise the conversion for a privilege. For example, if the market price of the stock is 25, a $1,000 convertible with conversion ratio of 50 would be worth 1250. So by calling the bonds perhaps 102, the company would force you to convert bonds. That's exactly right. Whatever where the more money is, what you're going to do.
Right.
So, boy, that's a long ass rationale too.
Yeah. I guess also in that question, what's important to note is what you can't do, right? And the other answers.
What you can't do.
I mean, the proxy makes no sense.
Yeah, shareholders do not vote on management decision to call in debt. That's true. But remember, they got to vote originally when we issue the bonds because of the potential dilution. I love Chuck. This isn't covered anywhere.
Yeah.
That's kind of aggravating as a test taker.
Yeah. It's like, what do you mean? It's not
anywhere because it doesn't exist.
Yeah.
Typically, new municipal bond issues are sold to investors before the bonds are issued. That's called a when issued basis. That's what that means. You know, I tell the story in my options lecture about I bought a car on a when issued basis. It doesn't exist. When it does, I'm going to be able to buy it, right?
Yeah.
So here, the issuer are available for delivery. An investor receives a when issued confirmation. I think of a when issued confirmation as a temporary confirmation.
Okay.
And we say, hey, Jimmy, we don't have the bonds issued yet, but when we do, here's your proof that, you're going to get them, because that's what a confirmation is, kind of a receipt. Describing them on what information is included on the confirmation. Well, we don't know the total amount due because we don't know when we're going to settle up with you.
Right.
The bonds don't exist yet. So you say, well, Dean, doesn't the total amount include the price I've agreed to pay for the bonds and the calculation of the accrued interest? I say it does, Jimmy, from the dated date up to, but not including the settlement date. And Jimmy, we don't know what the settlement date is. Syndicate is open. We're trying to sell the bonds. We don't know.
Right.
And if I can't tell you that, I can't tell you the accrued interest, because that's why I can't tell you the total dollar amount.
Right.
I don't know, Jimmy, when the syndicate is going to settle up with you. Because muni bonds aren't hot. Muni bonds don't fly off the shelf. Muni bonds get sold the old-fashioned way. Hey, Jimmy, Dean here. Would you like a 4% New York GO? I mean, that's how those things get sold. So syndicate could be open 2, 3, 4 weeks as we try and sell these bonds. And we're not going to actually print the bond certificates and do all that until we get all the bonds sold. Now, we do know the trade date, Jimmy. That's when you've agreed to terms.
Okay.
This is when you've agreed what you're paying for the bonds. And that we know because I'm talking right now on the phone. I say, hey, so are you in? You say, yeah, Dean, I'm in on a when issued basis. I said, Jimmy, okay, let's call that the trade date. Now, remember, this is where it's not going to be T+2, because this isn't like, regular rate trading of a bond in the secondary market.
Right.
This is a bond that doesn't exist yet. And so we don't know settlement. So let's see what Chuck tells us. The trade is known. There we go. But because the bonds are not available for delivery, the settlement date is unknown. True. Without settlement date, we can't calculate accrued interest. True. And there's no way to compute the total price. Absolutely. So again, I love this. Let's call this the Jimmy set. This Jimmy set is tough, but fair. This one's fair. So,
this was fair. Yeah, this is more like catch your breath.
I told you. You said you weren't going for those, and you so far have been successful in your mission of pulling some of these complicated ones.
Here's a good one.
All right, so you paid a premium of 10. Let's see, is this one? Okay, Tracy bought 10 municipal bonds. So I think what I would have done here first is say, okay, if she's paying 10, a premium of 10, I
Yeah.
think what I would have done right away is just because, I just like to have my information with me. So what I'm going to do is just immediately say that's 1,010
10.
per
Right.
bond. So that way I just don't go backwards when I start reading this thing.
That's right.
All right. So let's see. So she paid 1,010. She bought 10 of those. So, I'm going to just make a note to myself that we're discussing 10 bonds here.
So months, yeah.
Again, that's just so, my own, I would be doing this on my Prometric scratch paper. Are you going remote or are you going to the site?
No, I like going to the site.
I'm with you.
I feel
Totally
like
with you. Totally with you. So
the only thing that
I
what
always
killed
feel
me the
bad when
first
I ask a
time.
question. Somebody tells me they're doing remote. I go, please don't.
Yeah, what killed me the first time is that I didn't know that you had to wear a mask throughout the whole exam.
Yeah.
I thought you could just sit and not wear a mask.
No.
And
Sometimes I tell
wearing,
people to just practice wearing their mask. Just
I'm gonna have to wear a mask while I'm just taking practice exams because that was brutal, man. I was sweating. I was hot.
Yeah. Okay. So now the next thing we got to recognize is that this is a muni bond purchased at a premium.
Mm-hmm.
This is a muni bond purchased at a premium. And when we buy a muni bond purchased at a premium, we have to do straight line amortization downward called accretion or decretion. So we're going to have to do straight line amortization downward. In other words, what we're going to have to do is adjust our cost base. Now, there's, again, a couple ways to proceed. It's kind of like our options thing we did. Yep. One way we could proceed is by doing it, one with all the bonds at once. Another way we could do it is per bond. And I think what I'm going to do is per bond.
Yeah,
so we bought 10 municipal bonds for 110. So we're going to lose $10. So what I'm going to do is put my $10 loss there. Right. So I'm losing $10 because I'm paying 1,010.
Yep.
And I'm only getting back 1,000. And we're losing this $10. 110. Well, let's see, $10 premium. We're losing this $10. Paying a premium of $10 per bond. You've got 10 months with 20 years to maturity. So we're losing the $10 over 20 years. So what I'm going to do is take the $10 and I'm going to divide that by the 20 years.
0.5.
Yeah. So let's just put that there. And I told you my arithmetic sucks. So 10.
It's 0.5.
Yeah, 0.5. Okay, so now it says that she held it for 10 years. So now we're going to times that by 10 years because that's what we should have decreed.
Yeah.
So now what we're going to do is we're going to take that 0.5 we got and we're going to times it by 10 years.
We got 5.
Yep. And now we're going to get times 10, $5. You are correct. And so we should have written off 5.
Right. So
right. So now that means my adjusted cost base is going to be my 1,010 minus 5. My adjusted cost base is 105. Right.
Yeah.
And then she sells them for 107. Let's see, 107. Oh, 103. I want to check the question again. I don't know where 107.
So isn't that 1,030?
Yeah, that's 1,030 indeed.
Yeah,
that's indeed 1,030. So let's see. Let's get my eraser going here so I can get. I don't know what kind of brain for it there. Boom, get rid of that. And we sell for 1,030.
In your lectures, you've emphasized how this is not,
50% probability. So when I asked you, did you get this the thing about decretion? People say, half of them say yes, half of them say no.
I didn't get it. I didn't get this, but what I did get, I remember, was calculate the rights offering.
Yeah. Oh, wow. Okay. So, sometimes, and what happens too, just based on debrief, things that disappear and people don't see for a while, then they start showing back up again.
Yeah, right? I had to get the subscription price.
Anyway, so we made $25. And then I told you I do it per share. So then I'm going to times by the 10 bonds.
10, 250.
I like to do it that way just because I'm not having to multiply all the time. Right.
Yeah.
I do it
right.
once and I'm done rather than every time I'm getting a number, I'm having to divide. So, that's
Correct.
just a process question. So looks like it's 250. Now let's see how Chuck did it. Chuck probably did it one fell swoop. So let's see how he did it. So the answer is definitely C. And I'm going to clean this up here. The cost per bond. Okay. So it looks like you did the same way we did. So boom, boom, boom. Yeah. Okay. So I always like it sometimes when we both do things the same way. And sometimes I say, oh man, Chuck, I mean, God, why do you got to make it that tough? All right. Whoop. You're going to have to contrast. So I don't know. I'm just seeing our next question is about a closed end fund. And it is very testable. Mutual funds are very, very testable. And I can't imagine any draw in which you're not going to have to contrast an open end fund with a closed end fund.
Yeah.
Somehow, some way, you're going to have to do this. So, a Investment Company Act of 1940 prohibits a closed end company from pursuing all of these activities except. Wow. The Investment Company Act of 1940 prohibits a closed end fund from pursuing all of these activities except. I think I would have come up with D just because that's the only thing that sounds normal is the paying of the dividend, right? All these activities except. Let's see what Chuck says on this one. This is by definition.
You know what? I just remembered what crossed my mind. What confused me about this one, it's a closed end. I thought about ETFs. Right.
Yeah, those are different. They're similar, but different. Yeah.
Can you elaborate a little more?
Sure. The ETF. The ETF, you could do B. You could buy an ETF on margin and you could short the ETF. An exchange traded fund. The test question there is how does the ETF differ from from the open-end mutual fund? So where they're alike is that they're both diversified, but the ETF isn't calculating an AV once per business day. No. Whereas an open-end fund is. No. Yeah. You can't buy an open-end fund on margin because it's new issue. Consider new issue 30 days from the effective date. Right. So
the Securities Act of 1933.
Yeah. So that's very important. Just debrief somebody today too. And I would add that they are adding a lot of ETN questions. One of them, but ETN's exchange traded notes, remember, are debt instruments.
That's securities.
Contrast the ETN with the ETF.
So let me ask you something, Dean. They would never, when I think of closed end, I should never think of an ETF. I should always just keep it separate.
Yeah, keep it separate in your mind. That's right.
Okay.
They're similar, but you don't want to think of them as similar on the test. Exactly right. One of the challenges is getting all this stuff in the brain housing group and then working on delineating it.
Yeah.
Because there's a lot of stuff and there's a lot of words that are, mean the same. Sometimes it's the exact same word that means something different in the context. Mm-hmm. Right. Like open and closed. That word could mean a gazillion things. Sometimes it makes it tough on debrief because somebody will tell me they saw a word, but they don't have enough debrief to tell me in what context they saw it. So,
yeah, but
sometimes I just did a 66 debrief today and I had a guy who's a very bright guy. He's an attorney and he's, great guy. And he said he got a question on the 66 about a sofa. And I said, you got to be kidding. And I thought, well, listen, I don't think he'd lie to me. But then I was talking to somebody today who took it. That was a sofa, Dean. It was about which of the following is like a tangible asset. I go, why would they come up with a sofa?
Sofa.
That's what we kind of bitch sometimes. I show this answer set every time, every lecture. I get the opportunity to show somebody this answer set. I do.
That's why I threw this one in here because you've emphasized on how important it is.
This answer set. Now you're not going to get a gazillion of them, but remember when you purchase the option. So an option writer. So that means, and let's just get our T up here.
What I did is that I made a flashcard for this. I made a flashcard with the opening purchase, closing purchase.
The way I say it is angels weep for you when, we know something's there and then you're still not prepared for it. That's only a 1 point miss, but it's the kind of miss you can't really kind of start doing. I like to get to the first question I actually know I know the right answer to. And so when we're doing a short, That's
My
an
first question on the exam was already an options question. It was a straddle.
By the way, this is the same if we are shorting the stock. So
Yeah.
long or short the stock. So an opening sale is used to establish or
Sure.
add to a short position.
Right.
And so, that's how we're going to get going on a short position. And then once you have a short position, the way you get out of that, the way you do what we call the offset, right? The offset, again, is the idea that you sold this thing and now to get back out, you're going to buy it.
Right.
And that's called your closing purchase. And what you're hoping, again, is that that's going to be more money in than out, right? You sold it high and you bought it back low. And that's called your closing purchase. So in this case, it happens to be a closing purchase, but any one of these could have been the right answer, depending on what they're asking you. Right.
The wording on this one is pretty tricky too.
Yeah,
The option, right,
liquidate's a good point. They could say liquidate, they could say offset.
Offsets, yeah.
So, I mean, there's a lot of words for that. So, they could usually I put the word offset here, right? But liquidates. Yeah, by the way, they could use that same word going the other way, right? We could say, how do you liquidate a long position? And that would be D.
Yeah.
So, yeah.
So
definitely.
I look for eliminate. I look for
eliminate, establish,
offset.
use,
Yeah.
add to, but that answer set, high probability you're going to see that answer set.
Yeah.
I just finished we just had our lecture premiere on the channel, and I have that answer set in there again. I mean, I said, listen, every time I get a chance to put that answer set into a lecture, I do so. By the way, it also can impact your ability to understand options and other things, because this idea of the offset, if you don't get the idea of the offset, you can't do a T either, right?
Yes.
You don't know what goes in the dollar out, dollar in part of the T. If you don't know an opening sale is money in, and the closing purchase is money out, you won't be able to net. So
yes.
Given the NAV per share, ooh boy, you pick some winners. You pick some winners. Okay, so what we're going to have to do here, given the NAV and asking price, which of them could be an open-end company? So I think what we're going to have to do is we're going to figure out, the maximum we can charge in an open-end company, remember, is 8.5%.
8.5%.
So if we come up with a, we're going to calculate the percentage sales load. And if we come up with something greater than 8.5, it can't be open-end. It's got to be closed-end, right? Because you're not allowed to charge somebody more than 8.5%. And if we find out that the NAV is, the NAV is higher than the public offering price, well, that has to be a closed-end fund.
Yeah.
So we'll just go through this. So the first one we're looking at, what I'm going to do is I'm going to figure out again the percentage sales charge. The way I do that is I take the public offering price, $12, I minus the NAV, which in this case is $10.95. And I get the sales charge. I told you Dean's arithmetic is terrible.
Yeah, same
My
here.
calculator. And I get $1.05 is the percentage sales, or is the sales charge. So once I get that, then I'm going to divide that 105 by the public offer price to figure out what is
By 12.
the percentage. So I'm going to take 105 divided by 12 and
8.75.
ooh, that cannot be an open-end fund, because open-end funds are only allowed to charge
8.5.
So we can get rid of choice A. Get that one out of there. We look at choice B and there's no sales charge there, right? That's got to be a closed-end fund.
That's out of the question, yeah.
Yeah, so we got a 50-50 now. It sounds stupid, but process of elimination is a good test-taking trick, right?
Yeah.
All right, so let's look at our next one here. Let me clean up my thing here. And our next one is the 25, and the NAV is 2250. So 250 divide by 25. I get 10%. And again, what I did is I took the sales charge, 250, and I divided by 25. I found out it's 10%. That can't be an open-end fund, which leaves us with our last one, which is D. Now D, we take $1. That's the sales charge, 20 minus 19. And we divide by 20, 5%. That sounds reasonable. So the answer is D, by process of elimination. So what we did there was called process of elimination. Let's see what Chuck says. NAV plus sales charge. Yep. There's another requirement, 8.5. Yep. Yeah. Yeah. I think that's, again, fair game. Fair game.
Now that we're on topic of being speaking about mutual funds, when it comes to the I had it here, the capital gain mutual fund distributions and taxation.
Yeah.
Can you speak a little bit about,
Absolutely. So one of the disadvantages of a mutual fund is you give up tax control of your investments.
Right.
So, for example, Fidelity owns 10% of Google, excuse me.
Mhm.
Google went public at 85, and that's when Fidelity bought Google. They bought 10% of Google at 85. If I bought 1,000 shares of Google at 85, Jimmy, and now it's $1,000, and I'm looking at that position in my portfolio and I go, wow, unrealized, right? I've just been sitting around watching the Google go from 85 to $1,000 a share. That's $1 million position in my portfolio that I originally paid $85,000 for. And Jimmy, if I just watching it, that's not taxable. But if I sell it, I've been at risk for more than 12 months. I'm going to have a huge capital gains tax. I'm going to owe 20% on $915,000, basically.
Yeah.
Now, that means while my investment mind might say sell, my tax mind says, yeah, I don't think so. Because the capital gains tax is a transaction-based tax. The easiest way not to transact it is not to transact. Now, in a mutual fund, you're paying the fund manager to decide that. And so the fund manager, Jimmy, is the guy who's going to decide whether it's time to realize a gain. He decides when to realize the gain. When that portfolio manager realizes a gain, that will be passed through to you because what you own is proportionate ownership of that portfolio, right? You're a proportionate owner in this pool of investments. And he's either held it for 12 months or not. It's either going to be short-term or long-term as a distribution to you. So the capital gains distributions from a mutual fund coming through to you are taxable. Now, good news. The IRS has said under subchapter M or the conduit or pipeline theory, as long as that mutual fund passes that capital gains distribution to you, Jimmy, they'll wait and get it from you, and the mutual fund doesn't have to pay taxes. So, the mutual fund may or may not have capital gains distributions, depending again on how the portfolio is done, whether they sell it. Now, the other thing that the mutual fund has is it has investments that pay income streams. It has stocks that pay dividends. It has bonds that pay interest.
Right.
Yeah.
And dividends plus interest.
That's right. So now, that's right. So if it was a corporation, remember, if it were a corporation that I own, for example, if I own ExxonMobil, for example, ExxonMobil makes money, pays taxes, pays me a dividend, I pay taxes. That money gets taxed twice. And, if we didn't have the subchapter M or conduit or pipeline theory, what would happen is Exxon would make money and then, pay taxes, pay that dividend to a mutual fund. They'd pay taxes and then they pay it to me. And oh my God, I would pay taxes. The IRS has been kind enough, test question, very testable, to say that as long as the mutual fund passes through at least 90% of their net investment income, the IRS has been kind enough to say they'll wait and get it from the mutual fund shareholders. And that is very testable. And that's called DI 90 is a good way to remember this.
Yeah,
so the dividends on the stocks in the mutual funds portfolio, plus the interest on the bonds in the mutual funds portfolio, less the expenses, whatever that number is. Now in real life and in the test, mutual funds do way, way better than that. And the reason they do way, way better than that is because they're going to suffer huge redemption requests if they don't pass through that money.
Right.
Because, the mutual fund shareholders are going to say, what up? Wait, what up? Why aren't you passing
Yeah.
that through? So most of them going to do 99.9 because whatever they keep, they're going to pay taxes on. And, it's just not efficient. Now, there is another investment, very testable, that works very similar to this. Remember the other thing besides mutual funds that must
REITs.
pass through 90% of their net investment income?
That's REITs, right?
Right on. Good job. So you would buy a REIT for the same reason you buy a mutual fund: professional management, diversification, ease of ownership. But you're not buying a diversified portfolio of securities. You're buying a diversified portfolio of real estate or mortgages or whatever the case may be. Now, one of the mutual funds is kind of weird, kind of funky, is a tax-free mutual fund where they're
Right.
buying muni bonds.
Muni bonds.
And if it's a mutual fund that has muni bonds, remember the tax-free interest that they're collecting in the muni bond portfolio is passed through to you as a dividend. So the dividends that you receive from a muni bond fund are going to be tax exempt, because what the dividends in that fund represent are not dividends from stocks. It's the pass through of the interest or tax-free interest on the bond. So that one's kind of funky, right? That's
Right. So you
the
would always
dividends are
receive that.
tax-free because the dividends are coming from those muni bonds.
Right. It spits it out as dividends, not interest, because it's within a fund.
That's exactly right. And then I like this one too. You're immune from fluctuating interest rates. When I was a practitioner, I'd say, listen, Jimmy, we're going to be immune from this idea of fluctuating interest rates because I'm just going to buy these bonds and we're going to hold them to maturity. So even though you're getting a statement every quarter, don't worry about it because, it doesn't matter because we're not participating. So I kind of like this question Chuck has here. What he's getting at is if you just buy the bonds, who cares? Who cares?
Right.
So
to eliminate interest rate risk. Yeah.
All good stuff. Yeah. So, this one I would have done process of elimination. So high quality, long-term municipal bonds. High quality, long-term municipal bonds. No bond, muni or not, does well in a high inflationary environment. So here it says you have low inflation risk. Absolutely not. If you said that any kind of a bond has low inflation risk, I would take more than 1 point from you.
Yeah.
I'd say, listen, you can't be telling me bonds don't have inflationary risk. I mean, now there's an exception to that. I should say there's one exception to that. The only bond that doesn't have the inflationary risk.
Zero coupon.
Well, no, they do, but if you hold a maturity, it doesn't matter. But remember, we have this funky one.
Oh, tips. Yeah.
Yeah. So other than tips, A is out, B is out. C, a high inflation risk, low default risk. Well, it does say high quality, right? Muni bonds are considered the second safest form of investment after the U.S. government.
Right.
And then let's see what our next one is high market risk. And no, you have low default risk. You don't have high market risk because the assumption is you're not going to be trading the muni bonds.
Right.
By the way, A and B are bad misses. D is still a miss, but I mean, that's why you buy this thing. But when you buy a muni bond, that's usually their safe money. I found people don't get mad with you unless you lose their real money, and the muni bond money is real.
Yeah.
So, if you bump into somebody, they tell you got the muni bonds, they don't care if they lose money on the option contracts, but you start messing around with the muni bond money, that's the serious money. So you're still at inflation risk, right? Because muni bonds pay 2-3%, but if you're already rich, who cares, right? I mean, I joke.
Yeah, right here. You're already up there.
$2 million is still a lot of money. Right?
What do you care at that point?
Yeah. Each of these would be fun muni bonds. So I like it, by the way. Muni bonds are tough. If there were truth in labeling, a lot of people refer to this exam as the stockbroker's exam. And I really think that that's not truth in advertising. Because if it were truthful, we would call this the bond broker's exam. Because there are way, way more questions on bonds than there is stock. I mean, you're at least getting 20 muni bond questions, at least. And if you throw in the corporate bonds or you throw in the government bonds, you're easily looking at 35, 40 bond questions.
Yeah.
Of those investment questions, right? So it's right up there with options and mutual funds. So the muni bond category is big. Each of the following would be disclosed to a potential municipal bond buyer in the official statement, except. Well, the official statement is a prospectus-like document when selling muni bonds. It serves the same purpose. Same purpose as a prospectus. It's to help you make an informed investment decision. Right. So these are going to be things you need to know. So I think what I would approach this with is from the investor standpoint, what is things I need to know material to me deciding whether I want to buy the bond? A, am I interested where the interest in principal, how it's going to be paid? Absolutely. That is a material fact to me, right?
Yeah.
Do I want to know the credit rating of the bond?
Absolutely.
Absolutely. Do I want to know why they're selling the bond in the first place? Are they using it to refund? Are they using it to build a bridge? Absolutely. Do I care who prepared the document I'm looking at? No. No, just as long as the document. Now, that doesn't mean, I probably should understand underwriters probably going to have a more sales thing. Right? We were joking about social media. I haven't figured out a way to articulate this, but the guys who hate me, it's because they aren't salespeople. So they're kind of right that they think I'm a promoter because I am, but they don't know that's not illegal.
Yeah,
I come from the sales side of our business, and they come from the back office side of our business. I mean,
that's right.
I keep, I don't know how to tell them. It's just, listen, guys, what you don't like about me is, that I do promote, there's no doubt that, I let people know I had to come see me,
I could relate. I come from the sales side of the business.
Yeah. So,
it's different.
So, I don't think it means they need less great teachers or tutors, or whatever. I just think, I just feel like saying, listen, guys, we're just the same people. If we were at a firm, you still wouldn't like me because I'd be the sales guy and you'd be the back office guy, and mad that I'm the guy making the money, and you're in your mind doing all the work. Right?
You're looking at me. You're watching me do it.
Yeah. So, anyways,
Dean, what do you think? What do you think if for the last? I mean, I got like close to a half hour left, right?
Yeah, you do. Yeah.
Do you think it would be good just to possibly speak about different areas of the exam instead of just going through the questions?
It's your half hour. So
I mean, since we're here in front of munis. Yeah, we're in front of munis now. Let's just, I guess, if you could just speak about munis and the most important parts that should really focus on, like the trust indenture, the official statement.
Yeah, let's just get the whiteboard. I always tell people.
You know what I have in front of me as well?
What I highly
class notes from your class, from the original class I took with you.
Yeah, well, that's good because now we can do what I told you to do in class, right? So
exactly. I literally have.
Maybe you didn't do it. One big part of your exam when it comes to GOs or munis is distinguishing between GOs and revenues. And so one thing I always suggest to people is that maybe they take a sheet of paper and fold it in half.
That's right.
And on one side, write all the terms associated with GO bonds. And on the other side, all the terms associated with revenue bonds.
Right.
So distinguishing between these two is a big part. They just love, let me just give you some formats they love. On the test, they love least likely, they like most likely, they like except, right? And a lot of times those are going to be things like, which of the following is least likely a revenue bond? Least likely a revenue bond. Let me give you one. Least likely a revenue bond. A bridge. B, an airport. C, a toll road. D, a high school. Yeah, you charge the kids, they're not probably coming, right?
Yeah.
D, a prison. How are you going to charge the prisoners? I mean, you're charging the prisoners, they're not coming, right? I mean, what are you going to do? Throw me in jail? I'm already here. So they just love that kind of format. Now in the geo category, right?
Yeah.
In the geo category, we're going to be looking at people who have taxing authority, and that's going to be states and municipalities.
So they use
And there are 50,000 issuers of municipal securities. 50 of them are states. For 49,950 are cities, counties, school districts. And the big thing is that all of these over here are backed by taxes,
taxes.
right? And that means that this is going to require voter approval. Right? Big part of our thing is now the reason the voters have to approve this is because this is being paid through taxes. Now, on the state level, that's primarily an income tax. I'm coming to you from Nevada. There's a reason that lots of Californians like Dean end up in Nevada.
Yeah.
Because, California has like an 11% top state tax income bracket. Nevada, nothing. But for test purposes, that's an income tax. Now, local government, so if it's not a geo, state geo, it's not going to be a income tax. So again, it's like learning a foreign language.
Yeah.
And one of my favorite students here of late, and I chat her up all the time because I just think she deserves to be chatted up. Her primary language is Mandarin.
I've heard.
I can't even imagine trying to translate this from English to Mandarin and back. And good news, she passed away. She would call me and say, "Dean, this word is not even in my Google Translator." And I said, "Well, so I'm coming to you from a political subdivision called Clark County. So that's the test language for a county. I'm coming from a political subdivision of Clark County called Las Vegas. Las Vegas is a political subdivision of Clark County. And the way we say that sometimes on the test is that Clark County, or whatever county you're coming from, Clark County, and in my example, Las Vegas, are coterminous. Coterminous. That means Latin, they're living together. And what that means is that they share some of the same geographic boundaries and are able to issue debt separately. And again, we can use this to test you again on this idea of all the following except. Coterminous goes with GOs. Over here, feasibility study goes with a revenue bond. So they can say all the terms are associated except, or which are the most following, and are able to issue debt separately. So for example, Las Vegas is 100% coterminous, 100% coterminous with Clark County. You cannot be in Las Vegas and not be in Clark County.
Yeah.
However, Clark County is 100% coterminous with Las Vegas. You could be in Henderson or Summerlin, or you could be somewhere else. Now, remember, the reason this is important is because in terms of analysis of muni bonds, this concept means you as a taxpayer are responsible for the debts of both the city and the county, right? When I see, the police car running around or the sheriff, I'm paying for both those guys, right? So that's called overlapping debt. Main point is that's associated with GO bonds. Now, in this GO bond category, I think where a lot of people get hung up is they think there's a zillion muni bonds. There's not. It's a GO or revenue. Now, granted, there are a zillion subcategories. But at the end of the day, it's either a GO or it's a revenue. And that means when we do the voter approval, we have two versions we could be asking voters to approve. And the two versions we could be asking voters to approve is either a limited tax bond or an unlimited tax bond. And that's where I say, hey, Jimmy, we think we can build this new high school for $2 million. You're voting on the proposition for the school district. They're saying $2 million. Again, a lot of vendors, including Gap, I don't know if Chuck chose this to you, go over this idea of a mill rate, but you don't have to know a mill rate, but a mill rate is 0.001 of assessed valuation.
Yeah, you get a lot of those on the Cap and the Cuban.
Yeah, and so when I ask you for $2 million, is I'm saying, if, for example, if you have a $500,000 house, you won't have to do this on the test, but I say I'm asking you as a taxpayer to come up with another $1,000 in property taxes.
I hate when I get those on the Q bank because
Yeah,
the voice comes to my head like it's not testable.
I told you, I got to tell you, I'm thinking about a blog. I told you I'm new in social media this year, and one of my first blog posts is just going to be, and I believe this, I can't prove it, but since they changed the 7 from the top to the top off, I don't think anybody's called their Q bank, and nobody ever wants to call and say, "Hey, Jimmy, we used to have 3,600 questions, but we took out the ones that are no longer showing up, and so now we only have 2,500." No vendor wants to have less questions; they always want to have more. Right.
Yeah.
With me on my channel, my practice exams, I want practice exam 4 and 5 and 6. And someday I'm going to be able to chat up and I'll frost those guys. I got 1,000 practice questions, right? All for free.
All for free.
Anyway, so one thing you might say is, well, gee, because happens all the time. Cities are notorious for cost overruns. And so we start building the new gymnasium or high school or airport or whatever. And, now we need more money. And so 3 mills, 4 mills, 5 mills. Unlimited means hell or high water, whatever tax mill rate is required, we're going to get it from the residents. Right. I think more people are likely to pass this thing with voter proof. It's limited. We say, for example, limited, we say, maybe I'll just make up one. We say 2 mills, but no more than 3. And that means the bonds will default if that's the case, right? So 2 mills, no more than 3. Okay, so another version we have of this that goes over in this category. We have a double barrel bond.
The shotgun.
That's as I tell you, that's exactly right. Right, 2 promises or 2 shots at you.
Yeah.
I'm not a gun guy, but my brother, and I'm trying to bond with him, and so he said, "Hey, Dean, why don't you buy a pistol so we can." Go to the range and shoot together. I go, "Oh, yeah, fine, I'm in." Anyway,
every time I get questions,
what kind of pistol you want, Dean? I said, "I don't know, Chris, you're the gun guy. Get whatever pistol you think I should get." And so he's been jonesing for this thing. Anyways, he went and picked it up for me the other day.
Yeah,
it's got a clip that holds like 18 rounds. I'm like,
Jesus
God, I missed you once. I got 17 more shots. Right? So I said, "No, Chris, you're gonna have to pick me up a biometric safe because I want to be able to, I don't want the gun floating around anyway." Anyways, the first pledge, you nailed it.
Yeah.
If I miss you with the first pledge or promise.
It's funny, Dean. Every time I get questions, your voice comes to mind when I get a question and I'm thinking of the answer. Like, for example, here's a good one. The notice of sale, right? You always go, attention.
Yeah,
and I remember, attention. I remember it just like that.
Oh, that's great. That's good. I try to get a big kick out of the channel because I sometimes forget what I say, and then somebody will repeat back something I say. I go, "Oh, I like that." They go, "Dean, you're the one who said it." I go, "Oh, no wonder I like it."
Yeah, reggae. I'm not speaking about reggae music.
You say you what you got a 71?
71, yeah.
Oh, that's a killer, man. That just kills you. It kills you. So
I walked out of there. I was
hear my voice and get you the couple points. Okay, so now we're over here on this revenue side, right?
Right.
So, by the way, what you just brought up, by the way, that notice of sale, let's put that up there.
Okay. Competitive.
Notice that you're right on. That's exactly what that's going to mean. Right. And so there's 2 ways to do these underwritings. There's competitive and negotiated.
Dean,
and then
for the most part,
here you just kind of got me going down that direction a little bit. But remember, here you're going to have what's called the spread.
The spread, right? And that's what the managing.
The components of the spread. There's a couple ways to do it. You can do it top to bottom or bottom to top. But the 3 components of the spread are going to be the management fee,
the selling concession.
Right on.
Yeah, that lecture on the spread of the underwriting of municipal bonds is excellent.
I think it's spot on. That was one of my first ones. I think I got 2. I got that, and I got a normal one. But what happened is, it's so funny. One of the things those guys give me grief about is my lectures are an hour, and I never knew this, Jimmy. But who loves hour lectures is YouTube. They're trying to like raise TV. So I didn't intend to make our lectures because YouTube likes them. It's just what I did, and I monetized the channel last week, and I made $250 in advertising on my channel because they love my videos. So I'm like, whoa, I didn't even get that. But it was funny. Some guy called and complained, He said, Dean, all of a sudden there's all these advertisements. I said, it's annoying, isn't it? He goes, yeah. I said, well, I pay $12 to Google a month and not look at the ads. So,
That's it. Yeah.
so you pay $12. So your study effort, you're going to be with me 4 months, $48, and you don't have to listen to the do that.
Imagine. All
And
this
then remember,
content
you're
for
selling
free.
concession.
Selling concession. That's the largest individual component.
Right on. And then remember, if you're only collecting the selling concession, very testable.
Selling group.
Yeah. So, I mean, it sounds like you're spot on, my friend, on some of this.
And of course, you're not held
So-
responsible.
Well, it's, good. I feel pretty comfortable. One of the things people in tutoring sessions, I always want to tell them is if I think they're at risk or where they're at based on the
Right.
conversation that we've had with them. So let's go over this revenue thing over here. And over here, very testable. We don't need any voter approval because what do the voters care? I mean, you're
Right.
not, there's no stickiness to you, if this thing blows up.
Here's another one. Your example of the airport.
Yeah, I love it, right? No, your taxpayer dollars not at work, right?
Not at work.
And we're going to do the feasibility study over here. And then really testable, they torment you with documents. And so we earlier in your Jimmy questions from hell, I mean, your difficult questions.
You call them that. I would love that, Jimmy. Questions. Yeah.
And there is another very important document. It's going to be important for both these bonds, but it's even more important in a revenue bond than it is in a GO bond.
Okay.
And do you know what document Dean is hinting at?
The trust indenture.
You're right on. So that trust indenture, I'm going to put it over here just because it's more important as it relates to revenue bonds
Sure.
than it is as it relates to GOs. This document goes with both bonds. And, there's things that are not required in the official statement.
And you're
So
getting
one
that
thing
right.
that is
I was
not
going
in
to
the
ask you
official
that.
statement for both a GO or revenue. I'm putting on the revenue side just because the revenue components of this trust and indenture. In fact, let's just put what it is. Kind of a trick. What I mean by kind of a trick is it's not required because munis are exempt issuers, but we as underwriters say, well, listen, if you don't provide an official statement or trust indenture, it's going to be a hell of a lot harder for us to sell your bonds. But this is a written contract. Now in corporate bonds, this is required under the Trust Indenture Act of 1939, but we're talking about muni bonds. It's a written contract.
For
the issuer.
Dean, that for the corporates, that's any issue over 50 million. Is that correct?
Yeah, right on.
Right.
Written
Okay.
contract between the issuer and trustee, FBO, for the benefit of the bondholders.
Okay.
And one thing that we're going to find in here that is not found in the official statement. So there's a disclosure that we find here that is not required on the official statement and very testable. That's called the catastrophe clause.
So I'm glad you brought that up because I had it right here written down to ask. That's included in the trust indenture?
That's in the trust indenture, but not the official statement.
Oh, okay.
So this need not be disclosed to the customer.
Right. It's impossible to
And I always joke, right? It's bad energy talking about this, but if the thing blows up and you say, hey Dean, what are we doing? We're calling the bonds, we're using a catastrophe call. And you say, well, you never told me about that. And I said, I thought you had to disclose call provisions. I said, well, the MSRB, the Municipal Rulemaking Board,
Dean,
says
I'm
that's
gonna
the one thing that we don't
bring
need.
my brother into the apartment, okay?
Yeah, absolutely.
Just give me 1 second.
Yeah, I was surprised last time you unlocked it, nobody came through. I was like, what happened?
I know. I kept looking behind my shoulder. Like, somebody gonna break it? Just like,
I don't know. I was like, maybe it's gonna be one of those like YouTube things. Like,
yeah.
still nobody there, huh?
No, so I'm at my twin brother's apartment having a dinner.
Oh, okay.
Yeah, you're gonna see.
Oh, I bet that's fun. People like you. People know you're twins.
Oh, are you kidding me? He's exactly like. You'll see in about a second, man. There you go. We'll be walking in a second. Yeah, we're exactly alike, man.
Oh, that's great.
Same. Yeah.
I haven't heard of that yet. That'd be funny if we found like two brothers where one guy's taking the test for the other guy.
Oh, he's not. He wouldn't make it a second. So it's funny. We do completely opposite things. He's a teacher, and I work in finance. So it's like complete opposites.
Yeah, well, that's my brother. My brother and I are we're both loud and we're both. But it's funny, our voices are sort of like when he worked for me. He could
Oh,
actually
wow.
make cold calls and people would think it was me. He would tell it to me, but they'd say, "Well, Dean, why are you pretending to be your assistant when it's you?" I go, "That's not me." You know, so we can voice activate each other's stuff. Like, I can tell his phone to do things, and
I'll tell him to get closer when he comes by. So you can see how identical we are.
You bet, you bet. All right,
All
so
right,
we are talking about the stress and danger. So what are some other important items in this thing? Well, we talked about, but again, both for geos and revenues.
Right.
We're going to find out what the call provisions are.
Call provision, very important.
Right. We're going to find out if there's any put provisions.
And of course, call provisions is beneficial to the issuer when in a decreasing interest rate environment. Okay. And put for the okay.
What about put provisions? Who are those advantageous to?
Oh, for us, for the bondholder.
Yeah,
the
right on,
rate
right on, my friend,
up.
right on. You're on fire. Absolutely. Okay, so now the reason I brought this up is because there is a very important thing kind of the flow of funds as it relates to revenues. And that's why, even though this is for both bonds, not a legal requirement, but as underwriters would say, listen, we need to have this thing. An official statement, same way munis can say, hey, I don't have to do that. I go, yeah, but if you don't, it's going to be hard to sell your bonds. The other thing that's very important, why I put it in the revenue side, is we need to know about the flow of funds.
Right.
The flow of funds. And so that is found in that trust indenture. And then remember, there's two types of flow of fund promises. There's what's called a net revenue pledge.
Right.
And there is a gross revenue pledge.
Mostly, I recall from your videos, it's mostly net revenue.
Yeah, then remember the test question is, assuming it's net revenue, which you should, which fund has priority? Which fund has
operation and maintenance?
Yeah, man.
Yeah.
When you testing, you said next week?
Yeah, on Monday.
I love it. I love it. I mean, because
I figured
you don't want to be, you don't want to be close on this stuff and then waiting forever to do the data dump, particularly when you paid the price to have this stuff down.
Absolutely.
Okay, so one thing that's guaranteed to show up on your exam as it relates to Muni is suitability questions.
Yeah.
Suitability questions. And so in the category of revenue bonds, we have the IRS has two bonds that they are going to say are subject to the AMT. And the two bonds that they're going to say, and it would be unsuitable, therefore, for people subject to the alternative minimum tax, are going to be private activity bonds.
Okay. Private activity bonds.
And bonds that serve a public purpose, but are not essential.
Hey, this is my brother.
Hey, let me see.
He can't hear you because I have my headset on.
I could pick you out. Maybe not. Maybe I wouldn't be able to pick you out. Pretty damn close.
We're pretty close, man.
Hey, so he's going to be, he's passing his Series 7 Monday.
You get this guy to pass
this
his
exam. He's going to be rich and he can help his teacher brother out.
I'm watching him do this shit. He goes, can you please help me pass? Because he's tired of seeing me study.
Well, that's good. Like I say, it's different strokes for different folks, right?
Yeah.
Okay, so.
All right, so we got the private activity.
Okay, so now let's talk about what these are in English, because, the IRS is just, they don't ever talk in English, but private activity means that we're talking about an IDR.
Okay.
Or IDA.
IDB. Or IDA, sorry, yeah.
Yeah, so this is an industrial development revenue bond or industrial development agency bond. And so, I usually use in class the example of Boeing in Chicago. Chicago built them a corporate campus, or Schwab, Denver built them a 40-acre corporate campus. And so, these bonds are being issued by the Industrial Development Agency, and they're building a corporate campus, or in South Carolina, a factory for Boeing or whatever. But the primary beneficiary of these bonds is not Chicago or Denver. The primary beneficiary of these bonds is the corporation leasing the facility. So besides knowing that corporate credit backs the bonds, you also got to know that it is a subject to the MT. So I say, before I sell this to you, I say, hey, Are you subject to the AMT? This is where it's basically about $200,000. You take all your deductions, and then it looks like we owe you money for being a citizen of the republic. I say, no, 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 Jimmy. Try it again, tossing out these things. For example, I'm coming to you from my studio, my home office in Las Vegas. And for most people, a home office is deductible, but not if I'm subject to the AMT. These are what we call preference items. Preference items are the things they make people subject to the AMT toss out because that means they're going to owe some taxes. You're going to, by the way, if your taxes are enough, you won't be subject to the AMT. It's whatever number is greater. And so this is what we call a preference item. Another one would be intangible drilling costs. These are the things that the IRS is going to make you, not be able to use. Now, the other one is public purpose. And this one's called public purpose non-essential. Non-essential. Now, in English, what is that? That's a stadium. So, well, we spent $2 billion. I shouldn't say we, but we taxpayers in Las Vegas. They issued some bonds to build the Raiders this new facility. So that Allegiant Arena serves a public purpose, but it's not like building a high school. I mean, the major beneficiaries of that stadium are the Raiders.
Right.
50,000 of us get to, bond over the Raiders losing a football game, but that's not the same as a high school. And so again, if I were a broker in Nevada, I said, man, if I come out of retirement, what would I do? Who knows what I would do? But maybe I decide to be a broker in Las Vegas again. And if I did, you could know that he would fire up his muni bonds because, I'm trying to catch rich people, and a way to catch them is with some muni bonds. Say, hey, Jimmy, Dean here. Could you use some tax-free income? And I just heard we can't make cold calls anymore. So who knows? Dean maybe would struggle to figure it out. Anyways, I would try muni bonds. You say, hey, Dean, what do the Allegiant bonds pay? And I say, Jimmy, the Allegiant bonds pay X, so tax-free. I say, but listen, suitability-wise, are you subject to the AMT? Because if so, these Allegiant bonds wouldn't be good for you. Okay. Right, because they're public purpose, not essential. They're subject to the AMT. That may or may not be a problem, right? If you don't have a large income, maybe you're just a retiree in Vegas with a $10 million stock portfolio. Well, then let's buy the Allegiant bonds for you. It's going to be a particular type of person. Now, the other thing that's going to be very testable as it relates to suitability, and there's no draw in which you're not going to have to do this, is they're going to give you somebody's tax bracket. Guaranteed, they're going to give you a tax bracket. And the minute you get that tax bracket, you should know that what's coming next is either a taxable yield or a tax-free yield.
Right.
And what they're going to ask you based on suitability is, should the guy buy a muni bond or should he buy a taxable bond?
Yeah.
Right. So they'll say your customer's in a 35% tax bracket. Okay, what do you want to see first? A taxable version of this question or the tax-free version of this question?
Both.
Okay, so let's start with you're considering buying a 7% taxable bond. So they're going to give that to you. Now you're either going to multiply or you're going to divide to get the answer to this question. And if we give you the taxable yield, we're going to multiply to figure out what we're going to try and do here.
That's for the corporate.
That's right. And so what we're going to do to get this right is we're going to do 100% minus the tax. You're always going to do the things in the parentheses first. That's called the order of operations as it relates to math. So we're going to take 7%. We're going to times. Are you taking your 63 or 66 after this?
I already have a 63. I already have my 663, so I'm going for my 7 and 65.
Okay, so let's be on your 65 too. So learn it once, tested twice. So you have to do this twice. So we're going to take 100% minus your tax bracket.
You know what I do remember? I remember getting this on my first draw.
It's on every draw. I mean, this is high probability. Like we said, that straight line amortization down thing is like, 50-50. This is not 50-50. This is like 100% high probability.
Yeah. 100%,
so, we're going to take your tax bracket. Let me just, I'm going to fix this up here.
Something came to thought as well. On my first draw, I remember, and it was dealing with options. It was a question pretty much asking me if the client should have went the American way or the European way.
Well, it depends on what
For-
type of option is. That's options exercise.
Yeah.
So if it's a non-equity option, it's European style.
European, yeah,
You
like
can only
you, right?
exercise on last trading day at expiration.
Right.
And if it's a American style, remember that's typical of equity options, and the holder can
Equity.
exercise anytime.
Right. Okay.
Anytime.
That's
And then the other thing is that remember, if you exercise any time on that American style, then how they're gonna sign the exercise notice, and the OCC does it randomly.
right.
And then the firm can do it random, FIFO or another fair method.
5-4.
So very testable.
Right. Okay. Okay.
Okay, so
Thank you.
when we get this math done, what we end up with is the tax-free equivalent. All right, so here's how we do that. And we're gonna take 35%. And so when we get that number, let's get a different color here. We get 0.65.
Right.
And then we're gonna times that by 7%.
It's 4.5.
I just made it up, so I don't know what the answer is yet. We'll find out here in just a sec.
Yeah, I did
So
it here with my
7
calculator.
Times 0.65, 4.55. So I say, Jimmy, in your tax bracket, your 35% tax bracket, getting 7% and paying taxes leaves you with 4.55 take home. I think it was take home, right? Because when you make money, you don't get to take it all home. So here, you don't get to take the entire $70 home with you. You're going to take 4.55. Now, here's the point. If I can find you a muni paying 5, you should buy the muni.
Right.
And if it's a muni paying 4, you should buy this taxable yield. So that's the point of doing the math. So I can tell you whether you should buy a taxable bond or tax-free. All right. Now, the other version of this is I give you the muni yield. And so now I say you're considering a 4% muni. Right. So if it's a 4% muni, now I'm going to divide. So you either multiply or you divide depending on what they're giving you. Right. And so now we're going to take the 4% and we're going to divide by 100% minus the tax bracket, which was 0.65 or 65%. Either way, you can do math, a lot of ways to do math.
Yeah.
And I say, hey, listen, this time now you get to take that all home. That 4% is yours. Now I'm going to make sure, Jimmy, that I know what state you live in, because, the state could tax you, but chooses not to, if you're a resident, to give you an incentive to invest. Very testable, right? The other part of suitability is make sure I'm picking the right bond for you.
Absolutely.
And you say, Dean, I live in New York City. I go, wow, Jimmy, New York City has a city income tax. I mean, gee, city income tax, New York state income tax, federal income tax. My God,
Right.
you're triple taxed. You say, well, Dean, I understand that if I buy a New York City bond, the New York City could, but chooses not to, I could end up with a triple exempt situation. I go, yeah. He goes, is there a way to diversify my portfolio geographically? Is there a way I could buy something that's not New York City or New York State and still get all those exemptions? I say, yes, territories of the United States government. Puerto Rico, right? So sometimes there's a question about how I diversify somebody geographically, besides the obvious of getting you some upstate New York and some, New York City, and, the other one is to go outside of the state boundaries, right? So I don't know of many cities, New York City, Philadelphia has that. So let's see. So we're going to take 4%. We're going to divide by 0.65. And we find out getting 4% tax-free is the equivalent of getting 6.15 taxable. So we knew before we did this math, by the way, that the taxable bond was the winner, right? We knew that's the winner because we already knew that to beat that 7%, we were going to need something better than 4.55 from the muni, right? And we started with a 4% muni. So we knew from the get-go, this was going to be the loser because that 4 was already under this.
Right.
But, that's the test to go either direction. All right. Looks like we're coming up on the conclusion of our hour. Is there anything else that's on your mind?
Let's see. I'm looking I have everything pointed out here. Aside from what I tried to focus on what you've emphasized is really important, like options,
function
investment
3.
companies, mutual funds, and of course,
Function
munis.
3. I just had somebody today who passed, and they said, I use them to free write a basic on their comment. They said, Dean, that function 3 and the FINRA
Exactly.
content explication. I always tell people that's 91 questions. So that's not me actually, lecturing on it. But if you go to that playlist,
Yeah.
that function 3, I walk through all those investments, and that's 91 questions. Your point, Jimmy, you started correctly here. Function 2 in Kaplan. So function 2 in Kaplan, but according to FINRA, that's function 3. The test writing committee gets together and they come up with a chronological sequence of being a broker, right? So the first thing is trying to find customers.
Right.
So according to FINRA, that's in the content outline. That's number 1, seeks customers for the broker dealer. 12 questions. So don't call people before 8. Don't call them after 9. Retail communication over 25. Your principal needs to prove it. That kind of stuff. And then the second thing we do is open an account. That's critical function 2, sequentially, right? We open the account, joint tenants or UTMA or margin or IRA or 529. We open the account. And then nature abhors a vacuum, right? So now we have this account with nothing in it. And so now we're going to put some money in it, and function 3. Now we're going to buy investments. And that's the 91 questions about what people buy and sell: munis, options, mutual funds, partnerships, REITs, ETFs, all that stuff, right? That's the 91 question. Function 4 is what happens after the trade.
Right.
Now that's a handful of questions on, the confirmation, what's on the confirmation to the customer, that kind of stuff. So that function 3 is where it's at, and munis, mutual funds, and options are the biggest 3 of those 91. Those are the big ones.
That's very
And if
true.
your SIE, if you had your 6 already, and your SIE, I think you'd be okay on mutual funds.
Yeah, I'm confident on mutual funds. I have to say.
Yeah, so
I'm
maybe
confident on that.
options and your options, what you pulled were hellacious. You didn't come up with a normal straddle, you came up with a combo, right?
So that's why I purposely
you didn't
made
come up
sure.
with an intrinsic value, time value question. You came up with a parity question. So you were pulling from I wouldn't say the extremes of the Kaplan Q bank, but I'll say you were right up there with if I had to demonstrate to people that Kaplan can be as difficult as past perfect, I'll use the Jimmy list. I'll say we can be that difficult too.
Dean, please use that list. There's a lot. I
appreciate your permission. I'll wait till you pass Monday, because I always like to be able to tell people like Mike, hey, this person made their mark. That adds a little oomph to it. But I appreciate
absolutely
and I like you were organized. I always tell people too in tutoring, I always like people to have an agenda of some sort. So I appreciate the time you took. Moving forward. So you're one of the few people that we've tutored that is using Kaplan materials, and the advantage to you on that is moving forward. If you have a QID, you don't have to cut and paste or anything. You can just send it to me by email, and I can pull it up on my screen. I can see what you're saying, and there's no charge for follow up on questions from tutoring or when you're studying between now and Monday. Whereas my past perfect STC people I'm tutoring, I don't have their Q bank, so they have to cut and paste and send me. I mean, I still help them, but it's just more of a logistical challenge than if people are using Kaplan.
Okay.
And
the QID, where exactly is the QID? Is that the?
So if you have those questions, like you did your beautiful thing on the top right, let me just show you real quick. So let me stop here. Let me go.
One last question, Dean. Types of orders. I'm pretty solid on the slobs and bliss.
Yep.
And I'm good with that, man. I've been getting like 90s on like.
Well, you said your scores are fantastic. I can't imagine. I mean, I don't want to get hubris, as the Greeks call it, right? We want to get too full of ourselves, but based on your tutoring session, I can't imagine that you're going to have a problem. So, but that doesn't mean we don't want to do all the work possible. So let me just go.
What I haven't even really looked at much is margin. Just because I'm listening to you, I'm like, I'm not going to spend time.
I haven't had anybody call me and say, "Oh, Dean, you misled me, man. I have 20 margin questions." No.
I remember my first draw.
People are uncomfortable with. They swear. I had a guy who told me he had no options, which I don't believe.
What?
I just think he was so
That's
comfortable
impossible.
He didn't see them, and then whatever you're uncomfortable with, you're going to tell me that you had a gazillion of them. So
I had about 3 margin questions. I remember it was a combined margin equation.
So we were just picking. We just picked muni bonds, and so let me just show you here. I'm going to go pick. It doesn't matter because we're not going to do them, but I just want to show what it looks like. Okay,
yeah, absolutely.
So let me find you again. Boom. Okay, so can you see this question?
Yes, I can.
So
Oh,
see
there we
over
go.
here, let me get out my annotation tool. Over
Mhm.
here is the QID number.
Okay.
So if you send me an email and just say, instead of trying to cut and paste this and stuff, you could
Yeah.
just say Dean QID 1336621, and then I can pull it up and I can see what you're looking at.
And you can see that. You can see the QID after you have taken
Yeah.
the QBank quiz.
Well, no, when you see you would see that question. So let me show you. So let me show
Okay.
you what it looks like. So what it looks like to me. So let's write that down. Let me just write that down. So 1336621. So let me go back now and I'll show you what my thing looks like. Let me start my annotation. So if you send me a question like this one, I put 1336621, and I can see what that question is that you're looking at. I don't have access to your back office, right? So that's that
Okay.
question. I can pull it up by that QID number and see what you're doing. So sometimes, I mean, I wouldn't charge this for you. If you want to, if you just have a Dean to-do list and you got some QIDs,
Yeah.
like you did, it was beautiful what you sent me. But, you
Okay.
could just have a list of QIDs that you want to go through, and I can just punch them up and they come up and then we can do them.
That's great, man.
Or
I didn't know. I
Yeah,
didn't
it's
know I
called the
could do
QID.
that.
So see, it's
Okay.
missing here because I brought it in. So, but
Okay.
when I'm doing like, I do tutoring for Vanguard sometimes. Like I'll have office hours at Vanguard, and I'll say, "Hey, just bring your QIDs with you.
Good.
Any questions you want to talk about, and we'll punch them up. And let's see
Makes sense.
let's see. So like, okay, here we go. So here's some ones that people wanted to look at. So I don't know what this one is. We'll see.
Okay.
A question I found. So, but those QIDs can be helpful.
Yeah. That makes sense.
Okay. Anything else on your list?
Oh man, I wish I could
I think
keep
you're in
going,
good shape.
man.
I think you're in good shape. So I wouldn't be fearful. Are you a full-time
No.
studier, or you got to work while you're studying?
No, I gotta work while I study.
Okay. So how much time you have between now and test time? You can doing, what are you doing? One final a day, or are you trying to an hour
So
a
what
day? I mean,
I try to get in at least a good 4
that's
5
fantastic.
hours
That's
after
great.
work.
That's great. That's
Yeah.
fantastic.
And I just drill
What are you going to do?
questions.
Have you done the mastery yet, or did you reset the mastery on Kaplan?
I haven't taken the mastery. So
That's a gut punch. That's gonna be, man. That's gonna give you a kind of,
it's gonna it's gonna
I
shake me up.
long as you're 70, you're okay. But usually people go, I call it the bounce back. So
Yeah.
you're going to take that, and then you want to have time to take another one to get it out of your system quickly. But if
So
you're testing
Dean,
Monday, maybe do that Friday or Saturday.
do you think, because what I've been doing is I've been taking, let's say, about 60 to 70 questions on section 2 of the Kaplan, right, which is the largest
I love
section,
Love it.
right? So I'll take a big test, like 60, 70 questions, and then I'll take like 30 questions on the other parts just to stay,
I love it.
fresh.
I
Is
love it.
that,
When
would
people
you
make a big
think?
mistake, and when I love it, you're not making the mistake. I hate when people, instead of doing 60 and then 30, they do one
Yeah,
and they look it up because it just takes too long. You're looking up stuff
that takes too long.
you already
Exactly.
know.
I
So
like,
you're trying. It's counterintuitive, but you're trying to get through as many misses as you can. You're
right,
really trying to miss as many questions as you possibly can, and you can miss a lot more questions when you're doing 60 and 30 at a time. Then you
right,
can go back, and you're not wasting time going over things you know. You're trying to find more
exactly.
things you don't know. Love your list, right? You want to
That's what
find
I'm doing.
those kind of questions that will
Yeah.
elicit additional understanding, and then you just got to make sure you don't beat yourself up, because from now to test time, you're still going to be finding questions like that. When we're checking the explanation, this isn't anywhere in your materials. So,
I love those.
so,
I'm like, so where is it?
yeah. So you just got to know that that's still going to be the case. You're not going to feel, I wish we still gave scores, because I think there are people who deserve their score because they work hard and
Yeah, I
don't
mean,
get their
I
score.
truly
But
think
the
I
point
wish.
is, you got to remember, you're not trying to get a 90. You're just trying to get that extra 3, 4, 5, 6, 7 points. You want to get out of the danger zone. I think you're definitely out of the danger zone
Okay.
based on those scores. So you don't want to be at risk. So, but between being at risk and embracing the negative feedback of missing questions is the happy medium,
Right,
right? Where you're
right.
still missing, you're still learning. And I'm very happy you're testing Monday, because a lot of this stuff is minutia that tends to dissipate.
Yeah.
And based on your performance in this session, I would be telling you to move up your thing. If you told me it's 2, 3 weeks out, I'd say, well, I got to do that, man. You want to,
Yeah.
You want to do the data dump and get on with life, right?
Yeah, I need my life back. I'm trying to get this out of the way, man. I'm done with this. I don't even want to stare at it anymore.
Okay. All right, my friend. You know where to find me if you need me.
Dean, I'm a big fan, man. Thank you so much.
At least once before Monday, if not, sooner.
Absolutely, man. I'm a big fan. I check the Reddit. I'm on there. I'm on there. I'm on there.
I appreciate it. Like I say, I'm not used to the, who was that guy, Mr. Business or something? I mean,
Yeah,
oh my goodness, I didn't understand where the hate is coming from. I'm like, Jesus,
Sometimes I'm like, man, I got these back. I want to hunt them down. Who are these people, man?
He was on the channel, and I was pretty honest with him. He didn't like the channel. I said, well, good news, you can change the channel. I mean, I don't know what you want me to tell you. I mean,
it's a buffet.
Oh, you're right. I should listen to you or so. I said, I was with. I said, well, I'm trying to do narrative lectures, and he goes, well, they're long, and I go, yeah, they're long. I mean, it is what it is. I'm trying to, give you. If you don't like that, I don't know what to tell you. Like, were you suggesting I'm going to start deleting my 100 hours of, So, anyways, I just lost it with him, and I said, I don't like to get in tit for tat because that's not what we're there for. No, I just said, listen, good news for you. There's other channels. If you like short teasers, go for it. And so then I thought, well, am I going to leave it up? I'm not afraid of leaving it up because sometimes the confrontation actually adds to viewership. So I didn't have any problem with leaving his comments up.
No, you should.
On the channel, but I thought, I broker checked him, and he's at one of the firms I do a lot of business with, who I like them and they like me. I thought, I don't want to get into it with some baby broker on the channel.
No,
but I delete his comments on the channel, and then he shows up on Reddit. I go, okay, well, ban, boom, done. And then all of a sudden
keeps popping up everywhere. Yeah.
All right, my friend. Man. I'll talk to you later. And like I say, you should feel pretty good with your performance. And I can't imagine you're going to struggle on Monday, but I'm here for you if you need me.
Thank you very much, Dean. I appreciate your time. Thank you. Have a good night.
Bye.
All right. Bye.